Yo, a for Sikasem program any the baron. Your boy Patrick Fee, Her Life Radio, and I would tea. Send you see no, and say either third week or either the third week or the fourth week in Biano. You were high, you can't and once them, and then they better to home come kakra hano. Na ina so nim emi ade bia ne di sa adwumadi no menia ma we de yenimu so memo introduction na eja wa ye yi kakra
yo menia that's any tiefo ne adofo nyina se de yin me da se ene so mama ho kwan se me ne
reko
tiefo emra na ye medin sawaso nti medin di Alex Adomakwe Champon ye realtor currently me ne Samson Properties in ye adwuma nti my license is both Maryland, Virginia. But that's nana.
Yo, and a topic na become ho asem no a mortgage 101. I'm saying hold on, yeah, the free. Bro, na the internet ndi mo amekra o.
Really?
Eba, me trust me in a phrase I couldn't wait. Okay, bye. Yo, the topic and a become ho asem no a mortgage 101. Mortgage 101. Your basic questions are answered. Send you know hey our boy 10 biano. Basic questions be about mortgage and a behwe ho asem na yaka. Question be also bit me to chat man our suggestion na bisa na so bit me friend numbers ni nyina studio numbers WhatsApp numbers and I'll bit me joining so me the joining link no so beto ho because we joining be a contribution bisa so and so bit me at the about her link to join. You me the link no so atum ti wa person joining Yo, and yet, he said, Benedict can join in. Yo, me any start here, say.
Yo, sure.
Because I say mortgage, you can mortgage, crana, yet say. Then say a BBA, and then I'm no hair buy. Obetchi much kakra.
Yo, minia. But that's nana any tiefo bium and you yama obia.
Obiso me is that the question about MB. But they cost che mortgage, you can say mortgage, na you see a say.
Yo, nana, but that's any tiefo nyina said we can alien no your man who can see and samra manim. So ye no say can mortgage ni say any say why besia anase loan a ye kokobo na ye de den ye de tofie enti say ye u tofie a o ka wo sika eda wo dem di anke ne u pege o sika 300,000 400,000 no akwa akoto wade na chese ne obi anu ni asem but say bronika se mu no say woni sika de a then we say mortgage na wako na chese wako bank ho na waba obesia na odi akwa akoto enti mortgages no we have different type of loans in terms of mortgage in terms of loan terms, right? So obu onoma o choose 5 years, obi choose 10 years, obi choose 15 years, obi choose 20 years, 25 years, 30 years. Years ago krano before ansani benya the other recession, it came to a point that some even lenders were doing 40 years mortgage. The idea here was to stretch the length of the loan to make it more affordable. In short, mortgage nina and mortgage and say woko untumi entry adanika outright. na wokɔ na wakɔbɔ besia wɔ bank no na bia wodi bia to ase na bank no so dia aka no ma finance dia ma na se obi okra oni sika kra na wakɔ na on the bank na finance ni nyina 100% e dia ma no nti ka mortgage a ni nyina no na se kire no se wo bɔ besia wɔ bank hɔ na wodi akoto fie.
Yo, chief, with the in a mortgage, we say in simple terms, a mortgage is a loan that a bank or a mortgage lending institution provide buyers to acquire a house. In return, the house becomes collateral if the borrower cannot pay the finances. It is a okoto mortgage now. Send your wusi cheche mu twi do. So aputo kase bu abeka do. That means say more or less no wesi awo.
Ah, so wesi awo.
Ode kakra de to ase na si awo. Yo,
Yes.
with MB was coming in particular or the question about. I say, good evening, bosses. Please, what are the advantages and disadvantages of bi-weekly mortgage payments? Say a TB someone for bi-week advantages and disadvantages.
Okay. That's a very good question. So when it comes to bi-weekly mortgage, there's no downside to it, right? It only has a upside, which is all you get is advantage. There's no disadvantage because when you pay on a weekly basis, you and I know that when you pay monthly, you pay 12 months. But when you look at weekly in a year, we have 52 weeks in a year. So if we pay 52 weeks in a year, translation means that I think that you end up paying 52 weeks, right? And that you end up paying more than you are going to pay originally. So there's no downside to it, but only upside when you do weekly. You can either do weekly or bi-weekly. It's the same. Because when you do bi-weekly means that we have 26 bi-weekly in a year, right? So it's the same thing. You end up paying more. So if it's something that if you can afford it, then it's a good idea. So there's no downside. It's only upside.
Okay. So what does the upside now say? Your friend say me win term no. What do I gain?
Yes. So on the upside side now, just as if every year you are paying 1 month extra, that means that your 30 years mortgage become 23 years. That is what, according to statistics, and that's what it shows. Anytime in a year. So whether you are paying bi-weekly or weekly, but even in a given year, it's sort of 12 months in between. Now, what's another one? So another one can one. If you repeat it, you cut back 7 years of your mortgage term. So the advantage is that you pay your home quicker than expected. Translation, you save more on the interest.
Awesome. Yo, another year, say, how do I find a mortgage banker? I think lender, right? How do I say if I'm planning to buy a house? Do I see the realtor first before I go in for the financial stuff, or how is the process?
Yes, so I think you do both simultaneously, but the first of all is putting your house in order, because if you want to buy a home, which we've talked about it several times on this program, say putting your house together, right? So you need to prepare, right? If you have done your homework already, and then at least you'll be able to put your credit together, you've been able to put your savings together, your emergency funds, and at least in terms of your taxes, all the things that need to be done. And most importantly, emotionally, you've sat down, you've know what this home search is going to look like, and you are ready emotionally and all that. Yes. Then at that point, I would say you can start with a lender, but alongside, if you've discovered how do you call it, a realtor already, it doesn't hurt if you can also talk to the realtor simultaneously. The reason why I'm saying that, so maybe a Alex Bank and a bank into me loan. Na Hong Kong na wohwe ansa na wakoye yi. Nti whereas when you're realtor na or bank you want to apply with them, well, if you have discovered a realtor, then at the same time talk to him or her, because they might also have some kind of input, say ABI, recommending a lender, a banker for you that at least will help you to shop around. So you do both at the same time. But if you have not done your research, you don't have a whole lot of information, me credit the crown, down payment crown, minimum. Like if you see say, oh, let me not say that you don't have a lot of preparation in place, then right away it's important say you talk to how do you call it, a loan officer / a realtor before you do any move.
But in case why be infant say why your research can be for your advice, no, which one is the best to talk to first, or it doesn't hurt, either one is fine?
I mean, it doesn't hurt, either one is fine, because if your lender, if you have a lender or your banker you bank with that you're happy with, then so you are going to shop with them, right? Or if you find also a realtor, most realtors out there, they also have institutions they are affiliated with them that they can link you with them and all that. But I think it's it doesn't hurt if you talk to them, and it's also advisable even as realtors that sometimes if it's not something that somebody has really recommend for you that you are very certain and you are just going online, then I will suggest that you talk to one or two relatives, right? At least interview them. I mean, people call me to interview me all the time, and as I have to tell them what I represent and all that. So it's the same thing. You can interview realtor or relatives or even lender or lenders, right? Before even you commit to them, so that at least you know exactly what you are getting. And in the midst of all this now, at least there's going to be a common theme, or based upon when you talk to them, you'll be able to know, oh, this one was saying it, this one wasn't saying it, or based on information you've gotten here now, if somebody is telling you lies or something, you'll be able to, counter it and so on and so forth.
Yo, me feedback ana.
No, sorry, it's my phone and ringing, but no, I mean, just let me put it on silence.
Okay. Utemenka.
Mepa chine.
Yo. So still that's the feedback. Okay. Yo, yeah, share the next one. Say can say yet pre-approve. Any your friend say pre-qualify. Difference in any day is a pre-approve, pre-qualify. Yeah.
So you asked what is the difference between the two, right?
Yeah, because yet sad no.
Okay. I mean,
Yes.
there are two. The all of them is what the end is. One is qualified, but there's pre-qualified is some annuity funds. Yeah, anybody can apply for a loan, and based upon the raw data that one enter, a lender within short time or by the time we finish this program can tell you, oh, you have been pre-qualified, because one, he or she run your credit scores. You put in some kind of raw data in terms of your income. So based upon that, the system will give you pre-call, whereby say you qualify. So you qualify for it. Then that's instant, and that's like facial qualification. And then pre-approval is when the lender and answer bank no take it to further after you applied. like I said, now, okay, your credit score has been checked. It's fine. You put in an income. You submit all documentation, which is namely your bank statement, your 2 months bank statement, your 2 years W2s. If you are 1099, your taxes for 3 years or 2 years, because that's where your income is going to be taken from. And then also, no, they take a copy of your ID. And most lenders also want to see 30 days pay stubs. So if either 2 weeks or on a weekly basis, they need 4. And at that point now, they are able to gather these 4 things, no, analyze, okay, you said annually you were making $1,000. Well, your paycheck also corresponds to that you're making $1,000. You said, you are working here. They also do what is called VOA, employment verification, because you provided them with a pay stub saying that, hey, you work for Nana Befi and Co. Well, they were able to send, either electronic verification or written verification to Nana Befi and Co. Testifies, oh yes, it's true. Alex has been working with us in the past 3 years, and this is how much he makes up to date. So not just that you have provided them with those kind of documents that you put in application, but in terms of your employment history, they've been able also to verify, to ascertain that yes, indeed, Alex is working for Nana Befi and Co. So once those kind of things has been done, that is doing their due diligence now. At that time now, the lender has that 100% confident saying, say, yes, now I can issue you with pre-approval. That one, this kind of things that I'm saying now is the loan officer, the processor, and then finally now the document goes to the underwriter, and then the underwriter do what's called initial underwriting approval. And so when they say, yes.
So me bantino, and pre-qualify ni idea with your plug in the information keke, and on Andrew where verification process need to go through.
Yes, and any data you the borrower no when you apply, you submitted it, and then they run it through because they have 2 systems, AS, AU, and other. So like I'm saying, yeah, by the time even half hour of the show, now we will apply a pre-call because it's a raw data you enter. They run it through the desktop underwriting, and it shows the credit is good based on the income. You qualify for this, but they've not dealt into it. And so the second,
haven't gone through the verification process.
So the third one, the second one is when everything has been verified and the employment verification has been done as employee, because it can even be in the panocran where such as here, but the lender even doesn't know, or since we apply on cutting hours, but the lender even doesn't know. And pre-approval is when the due diligence has been done or has been collected by the processor and the loan officer, and the underwriter has testified. So that one we know is solid.
So at that point, now we say we qualify for any money. Emphasis say we agent. I wouldn't say we dear obey me at all, because sometimes the amount no so right.
That is correct. Yeah. That is correct.
MB, me hope say your question no your answer amount, Dan Ben so say Vivian and Ben say more question be a mo betimi ebisa si anase say we beto chat no so am so waba so de obetimi ebisa say wo so a yes as there say Ben your friend say MB so question na nya bibi a your friend say one tia say ya betimi aye na ya kire mo yo eti ye hwe yenya pre-approval no say ye hu de mortgage ye yenya pre-qualification which ya data ya input in hey na fe ni akwa approval na whereby ya verify the information that we plugged in. Now as I say no credit cry etimi say e be 300 now who qualify so the third line. Hey now before say ye be omo yes na money na no say is it credit score bem right. What's the difference between credit score, credit and FICO score? Different. Say your different score tabulations, right? them say FICO ne use more, and maybe cross use the other one, if friends say.
So like you said, now there are so many credit models out there. Apart from the three main one, which is nationally, accredited and also recognized by most lenders, which is TransUnion, Experian, and then Equifax. Those are the three sources of credit data.
Information.
American Hanman, the federal government recognizing, even though there are other sub ones. But FICO now, your FICO is anytime your FICO is what all the other borrowing, credit cards, anything. So once you see that FICO, you can be 100% certain, say that is what your credit actually look like. But on the other hand, in terms of mortgages, there's a different standard, there's a different model that mortgage company uses. And so if somebody want to see their mortgage score, you have to subscribe to either any of the credit bureau now. When you call them and say, I want to subscribe to mortgage score. And so, unfortunately, I've seen somebody with a FICO of 800, and then when they pull their mortgage score is maybe 740.
Less. Yeah.
And they are mad. Always your FICO is going to be higher than your mortgage pool. But why would somebody having a FICO of 800 and then their mortgage pool comes in 40 point, 30 point, 60 point lower? The reason is very simple. The reason why it happens is the mortgage pool factor in a lot of negativities, right? So sometimes maybe you have run late in the past, or you use something. All those kind of things affect the mortgage pool. So the mortgage pool now, in other words, the standard is high than the FICO and the one that people see them on like regular daily basis on the public. And so there are two models that we use. And so your FICO is not the same as the mortgage pool. If anyone,
what about baking?
No, yeah, those are no. You have to subscribe what's called the mortgage pool. No,
mortgage pool. No, and so yes. The mortgage is new.
Yes, you say you just want to subscribe for mortgage credit score. So with that now, then people will be able to see their rare mortgage way. So that's what I'm telling all the tier for and people are going to listen. They say, if you want to buy home and you are working on your credit score, sir, then I would suggest that you subscribe the mortgage score, no? So that at least once you are working and you see that it's going down, you're 100%. That one is 99.9 accurate. Say whatever you see is what the mortgage company is going to get.
And you say, how do we get that? Say, and I say, how do we get a mortgage score? No?
Oh yes, you any whoever is your wherever you subscribe your like those kind of annual credit thing, but the three bureau, no, Equifax, TransUnion, and all that.
Experian.
When the time say you want to subscribe to mortgage score, they will. Yep, they just attach it to your program. You pay something if you've already subscribed to one, you pay just a little bit, and then you have access to it. You can get one-time one that, or you can subscribe to ongoing. But I always advise people, say, if it's not a mortgage pool, now you are just want to see so your credit score is fine. Don't go pay $9.99, $19.99. To me, I think it's just it's nice, but subscribe.
Yeah, I mean, if you're not using it for anything, why pay for it?
Yeah, I mean, I always advise subscribe Credit Karma. Credit Karma doesn't give you a true score, but the good thing is that they report all your credit profile, so you know whether you are paying or not paying, and they give you a credit score. It's not 100% accurate, but it gives you a borderline, right? Yeah. So far as you are doing all the right things, you are not misusing your credit card, you are not running late, then unless maybe a collection be forced into place, your credit score always should be doing fine.
Yo, so now no, send your CT, send your credit score, no. The credit information, we all know how credit information, and normally they tabulate the score. So you have, everything in there, all your credit information. So what are the scores? No, dear kakana beka fa ho amaye. The scores are yenya any because minim say bi mo ho no ma say wo pay particular type of loan be a credit score be a wo say would answer. Obetimi talk here a little bit about the score and the type of loans that goes with NSA Nemakakra.
Okay, Medasi, thank you, Nana. That's a very, very good question for foundational buyers and for everybody. It doesn't matter. So, like as we know now, there are three types of loans. Loans, you mean, right? In terms of loan programs, there are several of them, but the types itself is three, which is FHA, which is a government loan, VA, which is a government loan, but that one, as it goes by it nominalized veterans loan. So it's for people in the men and women in uniform, either active or retired. And then we have the conventional loan, which is the private loan. So on a conventional loan, anything 620 can get it done. But are you going to get best terms? Of course, no. But on FHA, which is a government, 620 is a magic number that will make you very competitive. But we have what is called an extended program or expanded program for the government loan. And with that now, they can accept as low as 580 credit scores. But most lenders, before they will accept a 580, you need to bring down 10%.
Oh, really?
Yes, for the expanded program on FHA. You need to bring 10% down in order for them to give you a loan. There are a few lenders who can still accept the 3.5%, but they also want to see say you have reserves, right? So either you bring the 10 or you have reserve. Then there will be exception to taking you the 580 credit scores for FHA. So that is on FHA, and then VA doesn't go anything lower. They change it all the time, but the last time I checked, I know VA requires 621, right? Some banks can take lower one, right? But where the VA want you to be very competitive is 621 or better. The good thing about VA, as you and I know, is that because of all the people who are sacrificing their life, there's no life that is more worthy than the other life. Right? Your life is all of my life. Even it doesn't matter even the ranking. So when it comes to VA loans, it doesn't even matter your rankings. We all give the same treatment based on your credit scores. And so even somebody has an entry which is 620 against somebody with even 800, yes, the 800 is going to get a little bit of break in terms of interest rate, but it's not going to be a huge margin. Like because somebody has 621 and you have 800, there's like 1 point different. Unlike the civilian world, that score can play higher in terms of your rate, in terms of VA because all of us are sacrificing for our nation because it will be we pray be a prano. They try to limit that kind of price gouging for veterans and active men and women. So that is the credit score for that one need. But in all programs, we have the basic in credit scores, but the better score you have, especially when it comes to the FHA and the conventional. But on the conventional side, in most lenders, where you become very competitive is when your credit score hit upper 7 or more. Because in all the loans now, as with the section of VA, say yes, you can do 100%, but say when this car, let's say what 100% episode kakra to us here. Anytime you don't put 20% down now, you are required to have a mortgage insurance. And for FHA loans now, your credit score doesn't matter so much. It matters just for the rate. Because the government, just like VA loan now, the government charge you what is called upfront mortgage, 1.7% of the loan amount in exchange for better terms, right? And because of that, the government has set FHA mortgage, as 0.55 of the loan balance. So in that case, even if your score is lower, your mortgage insurance doesn't go up so much. So that is what FHNO, the government has done with it. And so a higher credit score or medium, you are fine. But when it comes to conventional loan, it is very, very important. Say, you always want to make sure that your credit scores is in the 7s or even higher.
Yo, yani enua Alexa Champon or a writer or DMV area or being or your friends saying a dine to mupa. And your topic near mortgage 101, your basic questions are answered, right? Your basic questions are here. Open so line so me the link to chat box no which mean the aba. And so open so leave a message so or your friends say comment, I'll be to me leave a comment or with mortgage in the comment section na me de to you know. Two person ba message me be aside to be. So bas na wo bibi so kan na betimi de questions so aba. I mean your question or hanum ye ba bibisa question or hanum. If I link into my chief answer. Link to join. Yo T open so join a link na me de ato no o unya sa link na o hit so betimi mo join. Yo yanko your question ba ko ha. Say any about so say my question is when you are the main applicant on a different say mortgage and there is a co-applicant, so a mortgage or a mortgage or application on the main, there's a co-applicant, right?
Mm-hmm.
Can the co-applicant also be on another mortgage as a main applicant? If so, what would it be the qualification on that? I hope so when you're questioning.
Yes, I have the yes. So
Okay.
I got a question. So but then is he saying that the co-applicant that is going to come co-sign, can they own a home and answer after the co-borrower? No? So there's two sides of this question, right? Because the two sides of the question is like, can somebody who own a home come and be a co-sign on my home? The answer is yes. And then can somebody who is a co-signer but doesn't have a home by themselves, after they co-sign for me, can they go
And
buy their
co-sign for
own
another person?
co-sign or buy their own home? The answer is yes, right? Because if somebody owns a home and they want to co-sign, all that's going to happen is that then they have to make a lot of income to show that after they have paid their mortgage, there's a supplement, and the supplement is what they are going to use to support this individual to buy their home. Or if they are a co-signer on a home, they should have ample income also to say, okay, I'm a co-signer on the next loan, but currently Ben also want me to help them buy their home. And so I also have sufficient income to support that one as well. So
it's all yes, but depending on your income and other things that they have to. Right.
But on the secondary one is that if they are co-borrower, like let's say, and which it happens all the time. I have clients like that they co-sign for someone and then later on they decided to buy their own primary home. In that case, so what I would suggest is that if you have co-signed for somebody, make sure that you trust them, but also know they themselves are paying the mortgage from their own account. Because when it's time for you to go buy your own, all the bank want to say, okay, you say you are co-borrower, yes, because your address is going to show that you don't live in that property. So that means you're a co-borrower. And because we have not, we call them non-occupant co-borrowers. I have people who are from out of state, they have co-signed loans from their family member, friends in other states. So in that case, once the one that you co-sign is able to prove 12 months of payment, showing it's coming from their account.
Yeah, account.
And then you show it to the lender now, they exempt you from your debt entirely. So even though you are on it, but you can be able to use your whole income to purchase a home of your choice.
Okay. If submitting a question as this one, I don't know if it's still ongoing or or if it's still in process, because of what you say as a co-main with a co-applicant, can they also be a main somewhere else? I don't know if it's in the process, but I think what you should say we are for Meaning say be still in the process, and that's all my area, and I say be in the process.
No,
Say,
if it's side by side, then you can do that.
you can't do that at the same time. You have to finish one.
Side by side, then you need to disclose is where they have to be enough disclosures.
Yeah.
Right.
So that means you have to finish one before you can go to the other one.
Yes, because if you are doing it simultaneously, then you need to disclose to both lenders.
Yeah.
So that they'll be able to make sure, say, okay, Alex is co-signing for Nana and Sister Vivian. At the same time, they are buying home. So then my income they need to verify my income enough to really validate, say, I'm capable of supporting both of you buy your home simultaneously. Then other than that, then it becomes like a flood.
Okay. So that means if you are caught in the process, there's going to be consequences. But see, who they are now.
Yeah. Because I didn't.
It's way better if you finish the other one and do it, because I think say no problem if you finish the other one, that's if you co-sign for somebody, another person, every money is coming from that person's account. It makes it easier. Say, oh, apply for one. Nipa na utu any. Say the okay. Na and more simple. I mean, follow up.
And it's not even just on home only, but I know that people are very nice and generous in our community and out there, and sometimes we talk about not co-signing, but nipa nipa, and some they are still good people with good heart who are very honest and sincere, that when you help them, they will make sure that they don't disgrace you, and answer they don't make you regret later. So still people do for friends and family members. There are good people out there, and I don't laugh. That is so, but all that so all I'm saying is that in any loan you are going to co-sign because of some of this feature now, make sure that they pay it from the account, so that in the future
now may affect you.
If you want to come off, and I say, like typical example, like car loan, and especially how do you call student loans, right? Some lenders or when you co-sign a loan for somebody and they get to a point whereby you want to come off, they don't even have to refinance the student loan. Some institutions are nice, they can look at payment history. So, oh, after this individual has graduated from school now, they've been faithful paying their student loan 12 months, 24 months with no default. So we can confidently say, we let you off the hook, right? Or even a car note, it does happen. And so in every loan that you co-sign for somebody, and make sure, say, the payment doesn't come from your end, or unless in a situation whereby people feel like, oh, they are not being honest. So you know what? In order for me not to get late payment, then that's the route. But in most cases, the recommendation is let them pay it, so that when it comes to some of this, pull yourself, you'll be able to do it. But the exceptional is different. Saying that, when in terms of mortgages, once you sign a mortgage for somebody, they can pay from the account for 100 years. So far as you are on it, they refinance. They cannot let you go off hook because of now the mortgage into the no. They have to sell it or refinance it before it can free you from the mortgage.
Yeah, in this situation, I will say in this situation, the first property is already bought for years. I'm saying with the money easier if the first property is bought for years. That's it's coming from the person's account. Now you want to buy your own one. That is fine. And if you can prove all those things, in your account, I think say boni nimsa, you'll be fine. Say would join is here. Alex Champon or Reta or DMV area near the Kasawa Bingo. But your friend said, dine to more where they pa and watch my a program be every month be either third or fourth week or High Life Radio Sikasem program. So young call what question be a bit be a to chat man. I said, wow, bit me the link no to your friends a comment no. Bit me joining in so I'll be a question so a bit me there Ben what question be a bit me there so also person okasaswa when you continue near ka yen hwe niam ma yɛmu bebree bi wɔ a yɛ credit score no ebi a ɛntumi nkɔ yi because yɛmu bebree hɔ a yɛnim saa de no yɛ how nneɛma bi wɔ ɛtumi impact yɛ credit score so bad nti no nti yɛka sɛ bad credit a ɛdeɛn na ma credit no ɛyɛ bad.
Thank you so much. That's a very good question. I will not use the word say the okay, but say credit, like your credit is not good, right?
Hey, that good, not good, bad difference. Okay, you can say credit
your credit score is fair.
It's fair. Okay, yeah.
Because in a credit way now,
credit score, I mean, who bad, who fair, right?
So we are trying to be professionals, and what the government is saying, the government doesn't say bad.
It's bad. It says it's fair.
I see fair, good,
very good,
very
excellent,
good, excellent.
Yes,
it's 4 categories I've seen. They started being it,
me who I know that good to correct me.
No worries. So, I mean, what puts more people credit score in a fair situation? There are thousands of reasons, but we just want to deal with the, the more, how do you call surface ones are people ignore. Namely, which is one, if you have like not paying your bills on time, that is one of the red flag problem. It always put people's credit in a fair position instead of good or better or excellent. So one has to make sure, say, you have to pay your bills on time. Translation, they're making, and that means the other side also is true. If you pay on time, your credit scores goes up. If you don't pay, you push you in a fair. So that is one. Two, if you have a revolving account, what is revolving account? Revolving account is credit cards. And the rule of thumb is that anytime you have any revolving account, in order for it not to take a toll on your credit scores, you can spend more than 30% of your revolving account, either on individual card or your total overall account history. So let me say, for the purpose of our conversation, if someone has a credit card that is $1,000, $2,000 credit card, on each card now you cannot go more than $300. And so the temptation that I always trap people is they feel like, okay, because of one of this card has a reward and point and miles, so if they want to buy something 800, they put the whole 800 on one card. You don't do that. Rather, I would say it's distributed. Even though the other cards might not give you the reward a point, or if you are going to do that, then make sure say you are using it as cash, and as you have the money in your account. So if you feel like, oh, it's $1,000 limit, this thing is 800, but the other credit card or credit cards don't have point, so I want to make use of the pointer. Well, you go spend your $800, you come home, you just schedule maybe $600 on online, or you call them on the phone, you pay 600. At that time, it's left with only 200. You are reporting 20%. You are fine, but and yes, idea the rule of thumb they say don't overuse your revolving credit card. And unfortunately, some people they run it. I mean, $1,000 we use 800.
They don't use it; they run it.
So we use 900. People even go to a limit, right? Now, because of the federal government rules and regulation, they are telling people say you need to opt in or out for over limit, just like the bank. Now most banks want you to opt in or out. Say, if overdraft, you approve or disapprove. So if you say you don't, that means that if you write a check and it's a CEDA, they don't approve it. So most credit cards also are doing the same thing, over limit. So imagine say 1,000, you spend 1,000 and eat into another $100 into it. Your reporter, you are done. So that is one of the things that need to be prevented. Use a 30% of your credit card or less on each card, or when you put all your credit limit together, make sure that you don't go beyond your 30 minutes. That is another one. Two, unnecessary inquiries. Some people, they have a lot of credit cards. They are not even using them. But any credit cards that are right to them, they want to get it. And it's not like they are even using them. Just to know, say, oh, I have a bigger credit limit. Unnecessary inquiry can also take a toll on your credit score. And unfortunately, anytime you make inquiry, those inquiries stay on your credit profile for 2 good years. So the more inquiries you make, the more your credit scores are going to go down. So please and please do not make inquiries if it is not needed, or calling your credit cards very often, or increase the limit. So that because, oh, a friend of mine says, oh, they have a 30,000, 40,000 in their credit limit, I also want to put my limit out there so that I can say, oh, I also have this. If you are not going to use it, please desist from it, because those kind of inquiries can affect your credit scores in a short term and even in a long term as well. So that is one thing that you want to do. Or even if you want to limit, ask your credit company, hey, this I want to increase. Is this a soft pull or a hard pull? Some banks, they have a soft pull. They have a soft pull that doesn't create an inquiry. But other than that, please stop making inquiries, because that can also take effect on your credit scores. And the last thing that sometimes even people don't know is how do you call it? Collections, right? Collections even also is one of the big ones.
Charge-offs.
Yes. I mean, by the time you get to collection, you've already got the charge off, right? Because when you own, when you owe me, I have to begin to say some magic a flu, and he said 1 3, then I have to charge it off. Then that become negative on your score. And then in addition, I will sell it to collection agency. And then the collection agency will try to reach out to you. If you don't respond, one or two we have to know is a collection don't just take a debt and put on it. Collection always write to you first.
It takes a while.
Takes a while. But once you ignore them, and the banks, they have the document that shows that you own them. Once the collection company is convinced that yes, it's true, Alex owns me, and you don't mind them, then they have the right to put on your credit report. And so if you hear anything from collection, attend to it. So collection also is one of the things that usually destroy people credit. Because I have a client came to me some time ago, and I've said it on this platform. She always thought that her credit scores was great, phenomenal. But when I interview her, we pull it. It was in a upper 600, and he's like, "This is not true." I said, "Well," she was arguing.
Right. Looking at it.
Right. So she was arguing, but I said, "Well, do you have a collection?" She said, "Oh, no. I pay my bills on that." I said, "Well, let's run it and see, because I'm suspecting you have a collection." So lo and behold, we pull it, and a $70, medical bill. That was a co-pay.
For how long?
Has made it. And it doesn't matter how long. Collection, once it makes its way.
No, I'm saying it has been there for how long? He didn't even know.
No, she didn't even know, right? So as soon as you pull it, the lender comes and say, "Alex, yes, there's a collection right there." I said, "Well, we can remove it." So give me the phone number. I gave it to this young lady. She called them. I said, negotiate with them, paid it, tell them that you want it to be removed, and they send a letter. Within a week, boom, we rescore it. A credit score went about 100 point.
Yeah,
just one collection.
Yeah, collection can help.
Those are the 4 basic things that I think messes up one credit. Put them in a fair situation.
Yeah, and one thing that I also know is that sometimes there's error.
Right.
Can you elaborate a little bit on errors that on a credit report?
Okay, that is also a good one. And one of the errors that usually happen to be with names, especially those of us who are sons and daughters of immigrants. Sometimes when you call credit card company and you are applying for something, they don't hear it very well. So they end up mistyping your name. Because sometimes me myself, that's happened in the part that they issue a credit card and your name is spelled wrongly. If it is spelled wrongly, you call them to correct it, but that has made it its way, because remember when they issue the credit card, it's already gone on the credit profile.
Yeah.
Or you apply for a loan somewhere and they end up misspelling your name, right? And some of us too, sometimes we are not even conscious of the fact that this first name and the last name, we just type them in, and before I realize your first name and your middle name, they've interchanged.
Straight. Mm-hmm.
Right? But the other data is right, so they enter it, and so when those kind of mismatches also make it way on their credit report, sometimes when they are reporting, it becomes like the system read it like they are two different people. So it's not able to go to the center where it's going to give you the boost. So I always tell people that please always cross-check it with these credit bureaus and make sure that your names are spelled right. And this also happens when people do name change, right? I mean, people changing their name is more prevalent in the immigrant community, and our women, not to put our sisters and wives on the spot, people get married and they change their last names, and they don't go back to call their credit card companies and change it. They are still holding on to the same old names, which is not right. So those are the things that can usually cause most of the errors that happens. And sometimes some of the errors happen to come from the bureaus or your bank or your lender.
Yeah.
You make payment, and here is a situation. There are so many things that can happen. They end up saying that you are late, and you knew you weren't late, right? You call them, they've removed the late payment. However, because when I call them, say, hey, I wasn't late, remove the late payment, or my focus is just on the fact that, hey, that $30 late payment, they've removed it. But guess what happened? That late payment has already made it to your credit profile. That Alex was supposed to pay us. Normally, one thing that everybody also needs to know, that every loan, they report it a day after the due date. So even though somebody say, oh, it wasn't delinquent, but if today is the day that is due 28, tomorrow 29th, most lenders will report it to the bureaus. So you call them after the fact and they say, oh, it was an error. Yes, we've refunded your $30 late payment. You
It's
are
already
just
on the way.
Yep, you are just happy with the fact that you get your $30. But if it's a genuine that you are not late, then you have to say, hey, make sure you don't report it to my credit bureau. Or if you've already reported, pull it back. And because most of us don't monitor our credit scores, they've already reported it, and you get that kind of dip that unexpectedly, because you are not going to buy something or something. It's already there, and years to come. And this late payment can stay on your credit 2 years, even up to 7 years.
Yeah.
And down the road, you realize that your credit score is not moving higher, and they'll tell you, oh, you were late on the so and so. So please, if you are late and you call them to remove it, and you know you have a case, make sure that if they report it, they recall it back. So those are some of the things that contribute to the error, Nana.